Welcome, everyone, to the Deep Dive from Talk Tickers. Today, we're jumping into Danaher Corporation's second quarter 2025 earnings.
That's right. We'll cut through the noise, pull out the key insights from their results and the call.
Exactly. Give you that shortcut to really understanding how Danaher's doing right now.
And it was, well, a pretty solid quarter for them, actually.
Right. What stood out?
Strong execution, definitely. Leveraging that Danaher Business System they always talk about.
Okay.
And they beat expectations on adjusted operating profit margin and, importantly, on cash flow.
Cash flow. Always key. So the headline numbers.
Sales came in at $5.9 billion for the quarter. Core revenue grew about 1.5%.
Modest growth, but growth nonetheless. And earnings.
Adjusted diluted net EPS, that was $1.80. That's up around 5% year over year. Pretty decent.
Okay, decent. But you mentioned the cash flow as the standout.
Absolutely. $1.1 billion in free cash flow just in Q2.
Wow.
Which brings the first half total to $2.2 billion. And get this, the year-to-date free cash flow to net income conversion ratio was 143%.
143%. That's really strong. Shows incredible efficiency.
It really does. And it gives them a lot of optionality, dry powder for M&A or buybacks, whatever they choose.
Right. Flexibility is king. So where did this performance come from geographically? Developed markets?
Developed markets were up low single digits overall. North America was just slightly up. But Western Europe had a really nice high single digit increase.
Interesting. And what about high growth markets? Often a bit more volatile there.
Yeah, they were flat overall. Good performance outside China was kind of offset by China itself.
China. What happened there?
Down mid-single digits. And that was mostly pinned on diagnostics.
Why diagnostics?
It's that volume-based procurement, VBP, and some reimbursement changes that kicked in late last year.
Right. The government bulk buying pressure on pricing. Okay, got it. Let's talk margins then. Gross margin.
59.3%. Pretty healthy.
And adjusted operating profit margin.
That was flat year over year at 27.3%.
Flat. With higher volumes, you might expect some lift. What offset the positives?
Yeah, exactly. They had good leverage, good mix, cost discipline. Yeah. All the usual suspects. But they were offset by productivity investments. They're spending money now to try and lower their structural costs for the long run.
Investing for the future. Makes sense, even if it keeps the margin flat for now. Okay, let's dive into the segments. Biotechnology looked like a strong point.
Yeah, biotech was up 6% core. Really solid.
What drove that?
Bioprocessing. That grew high single digits. And within that, consumables were up low double digits.
Consumables leading the charge. Is that demand for existing therapies?
Exactly. Robust demand for commercialized therapies.
Yeah.
The order book looked good too. Continued positive trends there.
But not everything was rosy in bioprocessing.
No, equipment sales actually declined.
Why is that? Still absorbing capacity.
Yeah, customers are still working through the capacity they added over the last few years. Plus, global trade uncertainty isn't helping big capital decisions.
Right, that makes sense. People get cautious. What about the pipeline, though? New therapies coming.
Pipeline looks robust. Still, lots in development, lots in clinical trials. Monoclonal antibodies are still the big focus. That's over 75% of their bioprocessing revenue.
And biosimilars, seeing growth there, too.
Definitely seeing an increase in biosimilar development activity. So despite the equipment pause, management's sticking to that high single-digit long-term growth outlook for bioprocessing.
Okay, makes sense. Let's switch gears to life sciences. That was down a bit, right?
Yeah, life sciences core revenue was down 2.5%.
What were the dynamics there?
Well, the instrument businesses were collectively down low single digits. Clinical and applied markets held up okay globally.
But academic was weak?
Academic and government demand, still weak. But on the plus side, they did see a bit of a recovery in pharma spending. Revenue from pharma customers actually grew.
Any improvement in China for life sciences?
Yes, actually. Some improvement there. Stimulus funding seems to be slowly turning into orders and revenue. Not back to normal yet, but better.
You mentioned instruments were down. What about consumables in life sciences, like genomics?
Good question. Genomics consumables were actually a drag. They saw lower demand for plasmids and mRNA from a couple of big customers.
And funding pressure.
Yeah. Plus, the funding pressure in early-stage biotech and academic research is still hitting that area.
But wasn't there some big innovation news in genomics?
Oh, absolutely. A really big one. IDT and Aldevron, their businesses in that space, played a huge role in developing the world's first on-demand mRNA-based personalized in vivo CRISPR therapy.
Wow. On-demand personalized CRISPR. That sounds like a game changer.
It really is a massive step for personalized medicine, and it shows Danaher's tech is right at the cutting edge.
Definitely one to watch. Okay, moving to the diagnostics segment. That was up.
Yep, diagnostics core revenue grew 2%. Solid.
How did that break down?
Clinical diagnostics overall were up low single digits. But if you look outside China, it was mid-single digits.
And Beckman Coulter.
Beckman led the way outside China. High single-digit growth, especially strong in instruments. That's actually their fourth quarter in a row of mid-single digit or better core growth outside China. Good momentum.
Nice consistency. What about Cepheid, the molecular diagnostics side?
Cepheid did okay. Respiratory revenue was a bit better than they expected.
But the focus is shifting beyond respiratory, right?
Exactly. And their core non-respiratory revenue grew double digits.
Double digits. Nice. What areas?
Sexual health, virology, hospital-acquired infections, all double-digit or better growth. It shows labs are using more of the test menu on those GenExpert systems.
And they keep placing more systems.
Yeah, the installed base is now over 60,000 instruments globally. That platform is really becoming standard.
Any specific test examples?
Well, they mentioned their multiplex edginitis panel grew over 75% in the U.S. Just shows that menu adoption in action.
75%. Okay, that's significant growth. So clearly innovation is still key. What new products did they highlight?
A few things. In bioprocessing, Sativa launched 2 new Protein A resins, MABS Lecture 70 and Prisma X. Those are for purifying antibodies, making manufacturing more efficient.
Okay.
And SCIEX, their mass spec business, launched the Zenoto 8600. That's aimed at enhancing molecular analysis, speeding up drug development.
Any new partnerships? Innovation isn't just internal R&D.
Good point. Yeah, they announced a new partnership with AstraZeneca.
Oh, interesting. Doing what?
Developing precision medicine diagnostic tools. It involves their new centers for enabling precision medicine and focuses on things like digital pathology, AI algorithms. Really cutting edge stuff.
AI again. We'll come back to that. First, management changes. There was news on the CFO front.
Yes, a smooth transition planned. Matt Guino is set to take over as CFO from Matt McGrew at the end of February 2026.
And McGrew.
He's moving to an EVP role, starting a gradual path to retirement. Looks like a well-managed internal succession.
Good for stability. Okay, back to those macro issues. You mentioned trade tensions impacting equipment orders earlier. Any update?
Still an overhang, yeah. Creates uncertainty about where pharma companies should build new capacity. Management thinks it might clear up in the next, say, 6 to 12 months.
And the financial impact. Tariffs.
They said their current tariff exposure is down to about $200 million. It was $350 million before. And crucially, they've managed to offset those costs through various actions.
Okay, managing it well. Let's talk about early-stage biotech funding then. Still sluggish. And how does AI fit into Danaher's view?
Activity levels are lower, yeah, but seem stable. Investment has definitely cooled off.
That they see AI as a positive.
As a long-term tailwind, yes. Their thinking is kind of interesting. They see AI potentially shifting spending away from early speculative compound hunting toward advancing the validated ideas through development faster and more efficiently, which ultimately means more therapies getting manufactured and commercialized.
So more business for Danaher's core tools and consumables in the later stages.
Exactly. It plays right into their picks and shovels model for the industry.
Makes sense. What about the volatility in gene therapy specifically? Things like AAV therapies, Sarepta. Is Danaher heavily exposed there?
Not really. Their exposure is pretty limited. They call themselves a protein house, remember? About 85% of their business is in established protein markets.
So a specific gene therapy setback doesn't hit them hard.
They said the impact is typically tiny, like a couple $100 for any single therapy, and their full-year guidance already assumed minimal revenue from specific gene therapies anyway. It wasn't a surprise for their outlook.
Good to know. What about China outside of diagnostics? You said it was firming up?
Yeah, seems to be. Slight growth in bioprocessing there, more solid activity in biotech and pharma, and life science tools are seeing more stimulus money flow through, though it's not quite back to normal levels yet.
Okay, gradual improvement. And finally, respiratory revenue. They beat expectations in H1, but are they raising the full year guide?
Nope. Sticking with the $1.7 billion guidance for the full year. Seems like it. They said they're open to revisiting it later if the season plays out typically, especially with most tests being those 4-in-1 combo panels now.
Right. So putting it all together for guidance, full year 2025 core growth still around 3%.
Still approximately 3%, yes.
But they did raise the EPS guidance.
They did. nudged it up slightly to $7.70 to $7.80 per share. That was $7.60 to $7.75 before.
What drove the raise?
Mostly good cost control in the first half and some favorable FX rates.
But I sense a but.
But they explicitly said they held back maybe another 15 to 20 cents of potential upside.
Really? Why hold back?
Primarily citing that variability in respiratory revenue and potential swings in FX in the second half. It's a conservative stance, basically building in a buffer for uncertainty.
Very Danaher. And Q3 specific guidance.
For Q3, they expect low single-digit core revenue growth, adjusted operating margin around 25.5%.
And life science is expected to improve in the second half.
Yeah, they expect life sciences to flip from that low single-digit decline in H1 to positive low single-digit growth in H2. Driven by easier comps in genomics, that firming China stimulus, and getting traction from new products.
Okay, so a pretty detailed picture. Overall, it really highlights Danaher's positioning, doesn't it? Strong portfolio in essential markets.
Absolutely. Driven by non-discretionary healthcare needs, strong secular trends, and that recurring revenue base is key, over 80% from consumables and service. That provides real resilience.
Plus the strong balance sheet, the Danaher Business System driving efficiency. They seem well set up to navigate complexity.
DBS is like their secret sauce, right? That constant focus on improvement allows them to invest organically and look at M&A even when things are uncertain.
So while the macro picture is still, let's say, messy, Danaher's focused on what they can control.
Their team, their portfolio, their execution. And we'll get a first glimpse of their thoughts on 2026 in the October call.
Which brings us nicely to our, let's call it the "This is not financial advice" segment.
Yeah.
Time for an outrageous but plausible trade idea based on all this.
All right, let's hear it.
Given Danaher's stability, their core consumable strength, the diagnostics performance, and that conservative EPS guidance, how about this? Long Danaher, short a high-flying, early-stage gene therapy pure play.
Ooh, interesting pair trade. What's the thinking?
Well, Danaher themselves just laid it out, right? Early-stage biotech, gene therapy. It's volatile. Investment has waned. It's 2 steps forward, 1 step back.
While Danaher's core is that stable 85% protein market.
Exactly. And AI, they think, pushes money towards later stage development and manufacturing Danaher's sweet spot.
So you're leveraging Danaher's resilience, their recurring revenue, their focus on the less speculative end of the market.
While betting against the funding crunch and clinical risks hitting those pure play, high risk, early stage companies, Danaher's limited exposure, which they've already baked into guidance, just strengthens the long side.
It's a bet on proven execution versus potential promise in a tough funding environment. I like it. Plausible. Definitely plausible.
So wrapping up this deep dive, Danaher's Q2 shows strong execution, financial resilience, even with headwinds.
Yeah, the mix of solid core businesses, disciplined management, smart investments, it positions them well.
But as always, remember, this discussion is just for informational purposes. It is definitely not financial advice.
Please do your own research, your own due diligence before making any investment decisions.
Absolutely. Thanks for tuning into the deep dive. We hope you feel better informed. Until next time, keep thinking about what's next in this dynamic healthcare space.